The market is closed, and Tilray Brands Inc. TLRY finished the last trading session at a price of $1.12, reflecting a 5.66% gain from its previous close. This upward movement, while seemingly positive on the surface, hides a more complex and, frankly, volatile reality. Investors looking at that green number might feel a sense of relief, or perhaps a renewed optimism for the long-struggling cannabis sector. They might be thinking that this is the beginning of a sustained uptrend, a sign that the company is finally turning a corner. But the cold, hard reality is that this one-day spike, even with elevated volume, is merely a blip in a much longer narrative of profound financial and operational challenges. The expectation is that momentum is building. The reality is that Tilray's journey is still fraught with significant hurdles, most notably its battle for profitability and its precarious position on the Nasdaq. That lifetime upward blip is a classic head fake, luring in the unwary while the foundational issues remain. The common market narrative for Tilray is one of a leader in a nascent, high-growth industry. It's perceived as a consolidator, a company with a sprawling global footprint in cannabis, beverages, and wellness, poised to capitalize on future legislative changes, particularly in the United States. This narrative suggests that Tilray, with its diverse portfolio, is a picks and shovels play on the broader cannabis boom, insulating it from the pure-play volatility that plagues smaller competitors. Yet this expectation is a sharp contrast to the financial reality. The company's recent earnings report painted a sobering picture. While net revenue saw a modest increase, largely driven by the beverage and wellness segments, the cannabis sector itself faced a slight revenue decline. More critically, the net loss for the fiscal year was staggering, primarily due to massive non-cash impairment charges. This indicates that while Tilray is busy acquiring and expanding, the value of some of its core assets is in question. The company is spending money and increasing its footprint, but it's not yet translating into a sustainable, profitable business. This tension between the market's hope for an industry leader and the company's continuous struggle with profitability is the central conflict driving every daily movement of Tilray's stock. It's a classic case of a high-growth sector operating on borrowed time and investor patience, a narrative you'll find in many speculative plays, from certain tech companies on Robinhood stock trading to biotech firms on interactive brokers trading. The question isn't just what Tilray does, but whether it can afford to do it long enough to see a meaningful return. Looking at the recent trading action, the last day's surge was notable, not just for its magnitude, but for its timing. It followed a period of downward pressure, and the sudden reversal suggests a short-term catalyst, perhaps news of a new product line or a strategic partnership. However, what is more telling is the broader trend over the past few weeks and months. The stock has been highly volatile, with its price swinging wildly. This volatility isn't a sign of robust institutional activity, but rather the mark of a heavily speculative name. High-frequency traders and retail investors using platforms like SoFi Invest or their individual brokerage accounts are likely behind these quick, sharp movements. The average trading volume, while high, is often a mix of short covering and retail FOMO, rather than long-term accumulation by major funds. The company's 52-week range paints the clearest picture of this instability, with a low of $0.35 and a high of $1.88, demonstrating just how much ground has been gained and lost repeatedly. This is not the pattern of a stable, maturing company, but of one constantly fighting to maintain its footing. Beyond the immediate market mechanics, Tilray's business model is a fascinating study in diversification within a highly regulated space. The company is not just a cannabis producer, it's a global lifestyle and consumer packaged goods entity. Its segments include cannabis operations, distribution, a burgeoning beverage alcohol business, and wellness products. The beverage segment, which includes brands like Sweetwater Brewing Company and Breckenridge Distillery, has been a key driver of revenue growth, offsetting some of the struggles in the cannabis division. This diversification is seen by some as a masterstroke, a way to build a profitable enterprise while waiting for more favorable cannabis legislation, particularly in the United States. But it also adds complexity and dilutes the pure-play cannabis thesis that initially attracted many investors. It means Tilray is competing not just with other cannabis firms like Canopy Growth and Aurora Cannabis, but also with established players in the craft beer and spirits industry. The company is in effect a hybrid with a foot in two very different worlds, and this hybrid nature can confuse investors and analysts alike. It's a classic case of trying to be a jack of all trades, which can sometimes result in being a master of none. The question for investors is whether they are getting a discounted cannabis leader or an overvalued, unfocused consumer goods company. The fundamental health of Tilray remains the most significant point of concern. The company is not profitable and is not expected to be for the foreseeable future. The most recent earnings report, despite the positive spin on revenue growth, was marred by a net loss of over $2 billion, a figure inflated by impairment charges. While these are non-cash, they speak to past acquisitions and investments that have failed to generate the expected value. The company's ability to generate positive free cash flow, though small, is a silver lining, but it's not enough to offset the deep red on the income statement. A key pressure point is the company's recent strategic move to regain compliance with Nasdaq's minimum bid price requirement. This is a recurring issue for many struggling companies, and it often signals a lack of confidence from the broader market. Tilray has to constantly navigate this issue, and the possibility of a reverse stock split looms as a potential last resort. This kind of action is rarely a good look for a company, as it often erodes investor confidence and is a clear indicator of a business in distress. Looking to the future, the outlook for Tilray is entirely dependent on two major factors: internal execution and external legislative change. The internal strategy hinges on Project 420, a plan to streamline its beverage business by rationalizing SKUs and optimizing distribution. If successful, this could significantly improve margins and profitability in a key segment. The company is also focused on expanding its international presence, particularly in Europe, where the medical cannabis market is showing signs of growth. However, the true game changer would be federal cannabis legislation in the United States. This is the ultimate pot of gold at the end of the rainbow that every cannabis investor dreams of. Tilray has a large U.S. footprint through its beverage alcohol business, which would give it a significant advantage in entering the U.S. cannabis market if and when it opens up. But this is a massive if. The legislative process is slow, unpredictable, and subject to political whims. Investors are betting that this will happen and that Tilray will be a prime beneficiary. But this bet is highly speculative. The company has a plan, but it's a plan that requires an external catalyst that is completely out of its control. Do you think the government will pass legislation in favor of the cannabis industry anytime soon? Comment below with your thoughts. The risk here is immense. If federal legalization stalls or never materializes, Tilray's valuation, which is propped up by this expectation, could fall back to earth, leaving long-term holders with significant losses. This is a classic example of a company whose reality is shackled to an uncertain future, a future where hope often outweighs a concrete investment thesis. For those using platforms like Fidelity Investments, or Interactive Brokers, this is the kind of high-risk, high-reward play that demands careful risk management. For those just starting out with something like Schwab Intelligent Portfolios, this stock would likely be too volatile for a robo-advisor's comfort. In summary, the story of Tilray Brands, Inc. is a compelling narrative of a company in a high-growth sector that is struggling to live up to its lofty expectations. While the one-day spikes and positive intraday moves might create an illusion of momentum, the underlying financial reality is one of deep unprofitability, significant operational challenges, and a business model that is a complicated hybrid. The expectation of a cannabis leader poised for U.S. legalization clashes sharply with the reality of a company burning cash and fighting for its Nasdaq listing. The future hinges not just on its own execution, but on a political landscape it cannot control. This is the core of the expectation versus reality dynamic at play here. Investors must look beyond the green numbers on a single day and truly understand the fundamental headwinds and the highly speculative nature of the future catalysts. Tilray is a powerful reminder that in the world of online investment and self-investing, a promising story is not enough. It must be backed by a strong and improving financial reality.